Hey, welcome back to The Dive. Today on the show, our producer, Chris, is chatting with Brent Kachuba and Matthew Fox from SpotGamma. But first, just a friendly nudge to tap on that subscribe button.
Hey, Matt. Hey, Brent. Welcome back to The Dive.
Thanks so much, Chris. Appreciate you having us.
Great to see you, Chris.
Great. Now, let's start with AMC. How big of a role has options trading played in AMC?
Well, we think the role of options in AMC has been huge. We've put a bunch of studies of this up on our site, and what has really happened in AMC over the last several weeks really is there's a huge options position at the 40 strike, and those calls don't expire until January of next year. So what happens is that there's all this hedging flow that's tied to the 40 strike. And if you look at a chart of AMC, you can see that the stock may pull away for a short amount of time, but inevitably it comes kind of rushing back into that 40 level. The other thing that you'll notice if you look at AMC, what typically happens on Monday and Tuesday is the stock will have a bullish move as traders come in and they tend to buy the front week's calls, like so whatever the next calls are, the next Friday's calls are. They'll rush in and buy those, and the stock will get bid up. And then as those calls start to decay, the stock drifts back down and seems to have a cap on it. Say on like Wednesday, Thursday, the stock performance will turn sort of south. So we monitor every single day the action in options in these meme stocks, and they tend to have a huge amount of impact. That is, options tend to have a huge amount of impact on the way the stock moves.
Right. Yeah, I kind of noticed that pattern every week. It's starting to form the pattern where it goes up on the first week, on the beginning of the week, and slightly drizzle down. So go to the middle of the week. Right. Now, we know the data changes rapidly, but what commentary can you pull from the data on AMC this morning?
Sure. So we'll show you what the latest data is here in our Equity Hub trading tool. And what you can see in here, if we enter AMC, is that this 40 strike is still where there's a huge amount of what's called delta position. So there's a lot of hedges tied to that strike. And if you look over here, you can see that the top delta expiration is not until January of 2022. So this references what I just brought up, the fact that there are these big call positions that sit out in January. And that's why we think this is kind of like a pivot area or a fair value point from an options perspective in AMC. And that's why we think the stock kind of hangs around that general neighborhood. Now, you also notice that most of the gamma, that is the hedging activity of the stock, is in this Friday's expiration. So that references back to what you just mentioned about Monday and Tuesday being generally like a bullish time for these stocks because traders pile into next Friday's calls, which happens to be the 6th. And then those calls decay and the stock drifts down. And then next Monday, they'll run into the next Friday's calls. And it's that cycle that sort of repeats. So you can see that's all laid out in the options data well ahead of time. And it's irrespective of a lot of sort of the theories of naked short selling and dark pool trading and the like.
Okay, interesting. All right. Our understanding is that orders flows from apps like Robinhood get sent out to large hedge funds prior to market open. How does this impact how we should think about options price action?
Sure. So there's a lot of theory by the AMC apes and the like that there's massive naked short selling and also a lot of trading in dark pools. And I think there are a lot of trading in dark pools, but that maybe not be as nefarious as a lot of people think. One of the things to note is that if there is a lot of naked short selling and a lot of sort of fraudulent activity taking place, then we wouldn't see the stock respect or trade to these options levels day in and day out. So we have the feeling or the opinion that it's options hedging flow that really controls this stock on a short-term basis. And we can see that in the data. The other thing to note is that when you trade in Robinhood or any other broker that offers a free, that is no commission trading, what they're doing is they're selling that order flow to warehousers. So these are, they're selling this flow to wholesalers, such like Citadel is one that obviously comes up quite often. So Citadel will pay Robinhood a per share or per contract commission or rebate essentially on any order that is sent from Robinhood's platform to Citadel's infrastructure or another wholesaler's infrastructure. So that's called payment for order flow. Now, that order flow generally does not hit a lit exchange like the New York or the NASDAQ, right? But the regulators require those transactions, right? Any trade that takes place has to be printed somewhere that the regulators can see, okay, this trade took place. So Chris, if you go into Robinhood and you buy 100 shares of AMC, that record has to take place, right? The fact that you bought that at, let's say, $37 needs to take place. That print needs to show somewhere. And so what happens is Citadel will print it in their own dark pool, and then that information is then sent to FINRA, who's the regulator at the end of the day. So FINRA can tell, okay, Chris bought 100 shares at 37. Citadel printed this in their dark pool or their off exchange venue, and that is the transaction that took place. So a lot of the dark pool volume is, or could well be, retail transactions taking place, right? So because Citadel wouldn't print that, it costs them money to, quote, print the trade at New York Stock Exchange, for example. They would print it in their own off exchange venue or their own dark pool, and that shows up as dark pool volume. So I think just a lot of that volume is not, again, nefarious or secretive trading. It's simply free payment for order flow taking place. The transaction has to be printed somewhere, so the print takes place in a dark pool.
Another hot topic concerning AMC is dark pools, right? What are dark pools, and what data can we use to monitor dark pools?
There are two types of exchange venues you can think about. There's the lit exchanges, which is like the New York and the NASDAQ, and then there's dark pools, which are off-exchange liquidity centers, we call them. And all that simply means is that generally each bank will have its own dark pool. Like Citadel has its own dark pool, JP Morgan, Morgan Stanley, et cetera. And they have their own pools of liquidity. So they have these specific exchanges that only certain entities can trade into. And what they're doing is they go out and they buy retail order flow, such as orders that come from Robinhood and other brokers, and they allow their hedge fund clients to trade against that order flow. And the reason they do that is because it gives better trade prices to the hedge funds. It also gives retail orders commission-free trading. So that's kind of what the balance is. The balance is, are you as a retail client getting a better fill in a dark pool because you're not paying for commission versus losing maybe a half a penny on your actual trade price, right? So if you, as a retail client, we're going to go to the New York Stock Exchange to trade, you may pay, say, half a penny more per share, but you don't have to pay commission, right? So what is the balance? Is it better for you? You don't have to pay commission versus getting a little bit of a better trade price.
No, are you saying that a normal retail investor can get involved in a dark pool?
So if you are not, so our understanding is, our view is that if you are not paying commission on your order, right? When you go into Robinhood or E-Trade or one of these other brokers that does not charge you a commission to trade, they are not charging you a commission because they are getting paid from a vendor or broker that runs a dark pool. So, for example, let's just use Citadel. Citadel will pay Robinhood, let's say, half a penny per order that they receive from Robinhood. So Robinhood is getting paid from Citadel's dark pool to receive that order. When you put your order into Robinhood, right, that order is sent to one of, let's say, 6 counterparties that all have their own dark pools. And the reason that these dark pools are set up is because the broker wants to take that order that you sent in, and they want to generally cross it with a hedge fund or let a hedge fund or someone specifically interact with that order. If you're a hedge fund and you want to buy 1 million shares of some stock, you don't necessarily want that order flow to show up on a lit exchange like the New York Stock Exchange, because you could be giving away information, right? If I'm buying a ton of shares in Microsoft, if I'm buying a ton of shares in a stock that's thinly traded, right, another trader or another fund may be able to pick up the fact that I am trading a lot of shares in the NASDAQ, right, or the New York Stock Exchange. They may be able to say, like, hey, look, we can tell by how many shares are trading and the way that things are trading that there's a large hedge fund clearly buying up this stock on the New York Stock Exchange. And as a result, people may start raising the price of that stock, right? But if I'm trading or buying that 1 million shares in a dark pool, since those prints aren't made public immediately, it's harder to tell what is happening, right? The liquidity or the way that I'm trading is concealed because I'm trading in a dark pool. Does that make sense?
Yeah, that part I understand. That's initially what I had in mind.
Dark pools aren't a bad thing. I mean, these are very large. There are very large groups that want to trade these stocks, and they help by providing liquidity. Even the trades that go through Robinhood or these brokers enter into a dark pool. So the banks provide these dark pools to their largest institutional clients, and that's a place where big buyers and big sellers can help by absorbing lots of these little trades that come in to make sure that there's enough liquidity that the price doesn't move more than it needs to. So dark pools have been around for a very long time.
All right, that sounds good. Thank you very much, Matt. One of the things we keep hearing about AMC is that the cost of borrowing for shorting is still very cheap. How does the cost of borrowing impact the likelihood of a short squeeze?
Right. So if you monitor the cost of borrowing AMC, the cost of borrow tells you if you wanted to short stock, if you want to short AMC, what would you have to pay in order for the right to do that? The higher the cost is to short the stock, which is an indication of demand. So right now it costs about 70 basis points, which is a little bit less than 1% to short shares of AMC. There's plenty of shares available to short if you wanted to do that. During the peak of the AMC move, where the stock was really shooting much higher, that borrow cost would go up to 20 or 30%, if not higher. And oftentimes there wouldn't be any shares to short, meaning if I wanted to short 100 shares, my broker would say there are no shares available to short. So what we're saying is right now, there's plenty of shares to short if I wanted to do so. And it's very cheap for me to do that, which indicates that the market and large players are not really interested in shorting AMC. The fact that there is a borrow and it costs so little to short is a sign that the demand to short shares of AMC is not there.
Well, I don't know. There's no shorting. I think Brent laid that out well. I think what Brent was saying was the borrow rate indicates how much the bank is charging you to short a stock over the course of a year. So if the borrow rate's getting into the 10, 20, 30% rate, you need to make 30% on that short just to break even. Mm-hmm. So it becomes its own governor cap that as you start to short more of a stock, it gets more expensive and you have to do more and more of a return in order to get an equal profile. People stop shorting it. And it does hit a point, as Brent said, where you actually run out of shares to short and it becomes hard to borrow or they can't locate shares. And that's when the squeeze really can pop. So these people that force short squeezes look for stocks that have high borrow rates because it means to an investor, it's expensive to try to short the stock. Back during, just after 9/11, this is 20 years ago, you could not short airline stocks for less than 30, 40% over the next few months because everybody was afraid to fly and no one knew what was going to happen to the broader economy. So those kind of timeframes are really interesting to try to figure out. Do I still think Delta is going to drop 40%? Because people still shorted it and paid 40% annual to short Delta. So these stocks really matters what the borrow rate is, as Brent said. So being right now less than 1% on AMC means that it's not hard to borrow. And it means that it's not a heavily shorted stock, which makes it less likely to squeeze than when it was 20, 30%, as Brent said.
All right.
Right. So the peak borrow fee for this year was actually 75%, and that was back in May. So that tells you that there is insane demand and there's a lot of risk in shorting that stock. Now, what's also interesting to note here is that there are sophisticated options trading strategies in which I would short stock against a long options position, right? So that I am risk neutral, right? And I can make money by shorting the stock and do what's called gamma trading, right? Buy shares back, reshort them, et cetera. So not every position is just a naked short, is just a short position for an outright bet that the stock is going to go down. And the other thing to note in regards to the naked short is if there are shares available to borrow, why would I go through the illegal practice of naked shorting if I could just simply borrow the shares to short, right? And they're very cheap. So you may want to, you could conspiratorially draw this idea that if it's super expensive to short the stock and I can't get a borrow, then I have an incentive arguably to naked short, right? Because, there's not a proper way to do things. But in this case, there are plenty of shares available to borrow at a very cheap rate. So if I wanted to short the stock, or if anybody wanted to short the stock, it's available to do so.
All right. Thank you for that. All right. According to one of SpotGamma's blog, the equity market has been in overbought condition for some time. At this stage, with all the money in the system, how likely is it that we could see a large market correction?
Right. So on our blog, we actually have some guest contributors who use SpotGamma data to derive some of their own opinions about markets. And I think the blog you mentioned there is from one of our guest contributors who feels that the market is overbought and that a sell-off is due. What we can tell for sure is that the volatility in the market has upticked quite a bit. So what has happened is as the market, as there's more leverage made available to the market, as there's more free money and interest rates are very cheap, leverage has increased quite a bit. And what that means is that how fast the market moves has increased substantially. So we would call that volatility, or the volatility of volatility has increased quite a bit, such that when the market drops, it happens very quickly, but then there's a very quick bounce back, right? The V shape happens very quickly. And Bank of America actually put out a piece of research that said that the recovery time from a two standard deviation move, right, from very sharp sell-offs, is the fastest it's ever been, meaning that the drop is very fast and the recovery is very fast. And we believe that's because of the amount of liquidity in the system, right? When you have high liquidity, you have high leverage, right? And that leverage is causing very rapid movements. So what could very well happen, we think is going to happen at some point, it's tough to pinpoint this, but at some point, the amount of leverage in the system gets unwound, right? And because there's so much leverage, you get a massive, very sharp drop in markets that doesn't immediately bounce back, because essentially the leverage breaks and the amount of shorts that come into the market and the unwind of all that leverage happens, and that leads to a very sharp correction. And we think that's likely triggered by something in the credit market. So we watch the credit markets to sort of figure out when the leverage or the amount of credit in the system is changing. But because of the way that put options and options positions are structured, the selling from the way that options are positioned, it would ensue or fuel a sell-off to the downside. So we watch the credit market for the trigger, and then the options market is likely to fuel a fairly steep correction. And we think that the 4,000 level is one that likely gets visited during the next sell-off.
And one other kind of simpler analysis from SpotGamma, just from our perspective, so it doesn't feel like we're making any forecasts about things, is, at SpotGamma, we don't predict which way the stock market's going to move for our subscribers. As Brent mentioned, we have content contributors that write out trade ideas and ways that they value both the fundamental markets with our technical analysis. But as a simple answer, the markets overall have had a strong backbone of the options complex. We analyze the options complex. When that's not there, we expect there can be a very sharp drawdown. So what we continue to see is gaps in the options complex, where if one of these other markets triggers volatility or downward pressure, it could really gap. And as Brent mentioned, that 4,000 level is what he is watching and we're watching here at SpotGamma.
Right. The next question is something that people are very excited about, I'm sure. All right. Just people wants to be early in the next meme stock, right? Are there any indications in the options market that shows, what could be the next social media hot stock?
At SpotGamma, we're constantly tracking this information. We've put out videos on Rocket Mortgage before it squeezed, and we put out videos on Wish, WISH, before it squeezed, and both are available on our YouTube page for free. So we put out these videos, we track those to try to give our subscribers a heads up, but also we have a really cool sandbox and a bunch of scanner tools on our site with Equity Hub, which Brent's going to walk through.
Right. So on our website, we have this Equity Hub tool, and we set up these filters so that you could identify very quickly which names may be squeezing next. So if we click on the sandbox tool, you can see that there are a whole bunch of different stocks in here. And if we select one, what we generally look for in a gamma squeeze is increasing call volumes and increasing open interest, sort of as the two baselines. So if you scroll down here, we can see the 5-day history in Mara of call volumes, and then also of open interest, which is the call total column here. So in this case, Mara's call open interest was building, and then on Friday, it dropped fairly steeply. And then kind of the same thing, call volume has been drifting lower here. So this stock is actually not a great squeeze candidate here, but if the call volume was drifting higher, in other words, if it went from 250 up to say 500,000 contracts, that would be the sign that the foundation for a gamma squeeze is setting up. So we think it's fairly easy to identify the conditions, but as always, you'll need some type of spark to kind of get the ball rolling, right? To get dealers to have to buy, for retail investors to come in and start buying the stock, that kicks gamma up, and then the options complex kind of is what really starts the squeeze.
This is a very interesting tool. Yeah. And how can they get into this?
Sure. So on our site, spotgamma.com, you can sign up. You get a free 5-day trial. This is the SpotGamma Pro. And you'll get not only access to this Equity Hub page, you get access to our dark pool indicators, as well as daily notes on the setup and analysis of the index options from myself and Matt.
All right. I know we mentioned this before. I mean, we slightly touched on this topic a few questions back, right? But just for the viewers, all right? There's some speculation that large hedge funds are heavily behind the movement in the stocks like AMC and GameStop. Do you see this as a likely scenario?
I actually don't think that's a likely scenario, and I can sort of lay out why that is. First, if you look at Citadel is one that's brought up quite often. The way that Citadel is making most of their money, and the same with Robinhood, is off of transactions, right? So Citadel wants to see a lot of trades take place in Robinhood. They don't take directional risk from their market making perspective, right? Meaning that they don't want to get in a position where they're betting that a stock is going to go up or down, because when you're a market maker, that's not how you get paid, right? A market maker or someone that provides liquidity to the market gets paid on a transactional basis. So they want to make a lot of trades and make a small amount in each trade, as opposed to saying, we think AMC is going to go up or down and bet on that, right? So from that pure perspective, the idea that there is a conspiracy of some type of Citadel to really squeeze someone one way or another doesn't make sense, because it kind of goes against what their foundation is as a business. The second is many of the prime brokers cut risk in the meme stocks earlier this year, particularly after GameStop. As we know, there was a bunch of hedge funds that did get blown up by the movement in AMC and GameStop and the like. And so a lot of the prime brokers, particularly after the whole Archegos saga, I don't remember, Archegos was a massive fund that blew up. Many of the banks cut risk, and they said, look, you're no longer allowed to short these meme stocks. You're no longer allowed to have naked options positions in these meme stocks. So they've the banks have disincentivized hedge funds from making bets on these meme stocks. And as you can see, there's borrow available, and the volumes have kind of calmed down in some of these names. So the risk reward really of the big funds playing in these stocks just doesn't seem to be there, like it was. And again, the banks have really cut risk substantially in these names, because they don't want to see another situation where their clients are caught short, right, and the stock goes up 500%.
But Brent, when you say going back to the height of what was happening, we wrote a piece on this that was also cited in Bloomberg and Wall Street Journal, that the effects that were happening were sparked by retail, but some of those really bigger movements, especially in that March timeframe, were pushed forward by hedge funds, based on looking at the size of the trades, the cost of the options, and the sophistication of the trades. So the second part of what Brent wrote about as a fueling was selling of puts. That's a sophisticated trade. Retail doesn't tend to do that as their first move. They tend to buy calls. So we believe that during the heights of the mania, that hedge funds did get in there and really accelerate what was happening. But as Brent said, the custodial banks and institutions put, again, a governor cap in place to try to dampen down volatility and stop that from happening. So right now, as Brent said on the other question, AMC has less than a 1% borrow rate. These stocks have kind of found a little bit of a medium where their volatility is just much lower. And so we don't think the hedge funds are in there playing as actively right now as they were earlier this year.
Right. And you can also see just the movement of these stocks. The volatility of these stocks has really calmed down quite a bit. So if you look at, say, AMC and GameStop, as the notional value of the price of those stocks went higher, the volume kind of wanes. And what happens is the stocks that tend to get squeezed a little bit more are cheaper, right? They're like the SoFis and Wishes of the world that are $10 stocks, as opposed to GameStop, which is $160, or AMC, which is a $45 stock, right? So we think what kind of happens there is that the interest fades as these stocks grow to a higher price level, right? Because less retail participants can get involved because the stock costs more. So you can just see there's a sort of a rotation in meme stocks out of higher price stocks and into lower price stocks. And a lot of that is retail volume, but we think that in general, the institutional interest has really waned. And we tell that by stock volume and also options volume.
All right, that's great. Thank you for that insight. Now, for audience who wants to learn more about SpotGamma platform, where can they go?
Absolutely. So you can come to SpotGamma.com. We have a free 5-day trial. You can get access to all of our products, every part of our website with that trial. You can also visit us at SpotGamma on Twitter, as well as our YouTube channel, which is YouTube/SpotGamma.
All right, that sounds great. All right, Brent, Matt, thank you again for giving us this interview, the Deep Dive family is always excited to talk to you guys. Are really, really smart people. And until next time.
Thanks so much, Chris. Appreciate it.
Great to see you, Chris. Thanks, buddy.
Thank you all so much for tuning in. We'll be back again tomorrow with more great content, so be sure to hit that notification bell.